This video is sponsored by Policygenius. More about them later. And hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one dangerous money myth, keeping too many people broke. You want to make money with stocks? Easy. Just buy low and sell high. When the market dips, you buy. And when it goes up, you sell. Easy as peasy, right? How hard can it be to time the market? Well, let me tell you. It is almost impossible. The Motley Fools define market timing as this: a strategy based on predicting short-term price changes in securities, which is virtually impossible to do. And studies have shown time and time again that most people who try to beat the market by buying low and sell high are actually doing the opposite. They often buy high and sell low. Now, why is this? Because the short-term price changes in the market are not based on sound logic and financial principles, but are driven by emotion and financial media. Stock price suddenly drops because the CEO was arrested on some fraud charges, but it has no correlation to the company's solid business operation. But when it comes to immediate stock prices, it doesn't matter. Investors still panic and sell because they feel uneasy about it. Stock price suddenly shoots up because a company announces it's investing $2 billion into artificial intelligence and changing its name to AIbusiness.com. Who cares if the company has no track record of success and makes pizza dough for a living? People buy because people love hypes. Bottom line, be careful of trying to time the market. The best way to win in the market is not to time the market, rather buying all the time. And buying not individual stocks you think will go up, but buying low-cost broad market index fund that represents a good chunk of the market. And if you do this consistently, you will win with investing. The number two dangerous money myth, keeping too many people broke. The myth that some investments have no risk, that they're risk-free, guaranteed to make you money. When you look at any investment, they often have the following disclaimer or some variation of it posted all over their materials. An investor may get back less than the amount invested. Information on past performance, where given, is not necessarily a guide to future performance. This is because with every investment, there is always some level of risk, most often multiple levels of risk. Even when investing in a low-cost broad market index fund, investing in the total market or the S&P 500 index fund is one of the smartest ways to invest in the market. Yet there have been many times in history when the market fell by more than double digits. In 2008, during the height of the housing crisis, the market dropped by 37%. In 2001, during the dot-com crash, it fell by 12%. And the worst, in 1931, during the height of the Great Depression, it crashed by 44%. And in your lifetime, you'll face many more double-digit dips and downturns in the market. So accept that and embrace it. And if anyone approaches you saying that their investment is different because it has no risk of losing money, run away and very quickly. But before we move on, a word from our video sponsor, Policygenius, the country's leading online insurance marketplace. In talking about investment risk, do you know what else is also very risky? Not adequately protecting ourselves and our loved ones. For me, one of life's biggest transforming event was when I became a father. Becoming a parent completely changed my life. Life was no longer about me and me alone. I now had real human beings that I was responsible for. Therefore, one of the things that my wife and I did as soon as the kids were born was to get life insurance. We wanted them to be always protected, regardless of what may happen to us. However, finding the right policy can be overwhelming. Well, no worries, because Policygenius can help. Policygenius helps you easily compare your options by getting quotes from America's top insurance in just a few clicks. And if you need additional help, they have a team of licensed, award-winning agents who will walk you through the process step by step. Yes, some of you might already have life insurance policy through work. However, it may not be enough, not offering enough protection for your family's needs. Also, they don't often follow you when you leave your job. With Policygenius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. Also, Policygenius not only simplifies the process of getting you and your family covered, you can also get unbiased advice from a team of licensed experts. Because these experts don't work directly for the insurance company, they have no incentive to recommend one insurer over the other. Additionally, Policygenius has thousands of 5-star reviews on Google and Trustpilot from customers who found the best fit for their needs. So check life insurance off your to-do list in no time with Policygenius. Head to policygenius.com/financialtortoise or click the link in the description to get multiple life insurance quotes for free and see how much you can save. Alright, with that said, let's get back to the video. The number 3 dangerous money myth, keeping people broke. The myth that this fund manager will consistently outperform the market. Other fund managers suck, but this fund manager is different. He or she is special. They have and will continue to outperform the market. If you think about it, this single myth essentially is the reason why the whole actively managed mutual fund industry exists and has thrived so far. The myth that there are superstar fund managers, and because they're super smart and know what they're doing, They'll find winning stocks and outperform the market on our behalf. And all we have to do is hand over all of our money to them. Who cares if they're charging us an arm and a leg? It is a privilege to invest our money with them. While everyone else is trudging along with measly market returns, we get to ride the wave of glory with these superstars. Well, the sobering truth is this, that we all could do as well, or actually better, most of the time by simply investing with an index fund that tracks the total market or the S&P 500. Another benefit to investing in a broad market index fund? They are cheap. And I mean super cheap. They barely charge anything to invest with them. The Vanguard Total Stock Market Index Fund, VTSAX, charges 0.04% expense ratio. The Fidelity Total Market Index Fund, FSKX, charges 0.015% expense ratio. The Schwab Total Stock Market Index Fund, SWTSX, charges 0.03% expense ratio. In contrast, many actively managed mutual funds managed by these so-called superstar fund managers often charge 1%, sometimes going up to 2% expense ratios, multiple times the cost of simple index funds. Don't fall into a dangerous myth that your fund manager will consistently beat the market. They might get lucky for a few years, but the chances are over the long run, they will underperform and fall short of your expectations. Number 4 dangerous money myth, keeping too many people broke. If you're currently broke and you want to become rich, you just need to make more money. A recent Lending Club study showed that a third of consumers earning $250,000 a year are living paycheck to paycheck. Just to be clear, $250,000 a year is $250,000. I don't care if you're living in New York City, New York, or Manhattan Beach, California. $250,000 is still a lot of money in my books. And if you're living paycheck to paycheck earning $250,000 a year, you don't have an earnings problem, you have a spending problem. If you're not managing your spending well, it doesn't matter how much more money you're making. You will never have enough money left at the end of the pay period to save and invest for the future. Want to see an extreme example of this? Just take a look at MC Hammer's finances. In the 90s, when I was growing up, MC Hammer was one of the hottest rappers in the industry. With hits like You Can't Touch This and his signature Hammer pants, he was raking in millions in record sales. At the peak of his career, he was earning up to $70 million annually. I'm pretty sure most people saw this and automatically assumed MC Hammer had it made financially. I mean, if you're making $70 million a year, you're already rich, right? But sadly, no. MC Hammer made a lot of money, but he spent way more. At one point, he owned 17 luxury cars, a private jet, 2 helicopters, and 21 racehorses. And in 1996, he filed for bankruptcy with over $13 million in debt. Mr. MC Hammer went from Mr. Can't Touch This to Mr. Can't Afford This. If you're broke, don't think that more money will solve your problems. If you don't know how to rein in your spending, you'll just dig a bigger hole once you start making more money. Number 5 dangerous money myth, keeping too many people broke. The myth that you cannot become rich with a boring 9-to-5 job. When you watch too many social media financial gurus, it is easy to believe that the only path to one day becoming rich is to quit your boring 9-to-5 job and start a business. You hear these messages all the time. You need equity in a business in order to build wealth. Everyone on the Forbes billionaire list are entrepreneurs. So ditch the 9-to-5 and go pursue your dreams. Yes, sounds great, right? However, the reality is that when you look at the data, 9-to-5 is still one of the most common ways that people build wealth. By educating themselves, developing a great career capital, earning a strong income, and saving and investing that income for appreciation. Not all millionaires started a sensational internet business. Not all millionaires started a marketing agency. And not all millionaires became wealthy by flipping real estate. Now, I'm not saying that these are not legitimate paths to wealth. If you do want to start your own business, then you definitely should. I've seen tons of people build sizable wealth as successful entrepreneurs. We should just be careful when someone says that is the best way and the only way. Because in my book, that is a myth. Not everyone wants to be an entrepreneur. And we shouldn't be pressured to become one just because we want to build wealth. It is very much possible to build wealth through a boring 9-to-5. Number 6 dangerous money myth, keeping too many people broke. That my financial advisor knows best. They know money and they know what to do with it. So they know what the best financial path forward for me is. Now, I'm all about acquiring more information, whether through self-education or by consulting with professionals. However, when it comes to financial advice, I feel we need an extra filter. To be honest, there's a lot of bad financial advice out there, given by people who call themselves so-called professionals. Financial advisors, investment managers, fund managers, and even yours truly, personal finance YouTubers. Now, I'm not here to say all are bad because many are hardworking people. However, what I have issue with is when they're operating with a conflict of interest. Many financial advisors, especially ones being paid via commission, will push financial products that have the highest commission rate, not products that best fit our needs based on our unique investment goals and life stage. So don't just blindly trust someone just because he or she says they're a financial professional. Do your homework. Ask good questions. How are you compensated? What are the expenses? What are the alternatives? And if your spider senses tell you something doesn't feel right, don't be afraid to walk away. Your financial advisor does not know best. At the end of the day, only you do, because it is your money. So educate yourself and grow your financial acumen. Number 7 dangerous money myth, keeping too many people broke. The myth that there are 2 types of debt, that there is good debt and there is bad debt. The danger with this myth is that we start to accept debt as a normal way of life. It is okay to have some. Actually, it is okay to have a lot, especially the ones considered good debt. But in my book, this is a very dangerous line of thinking. Think about how we approach fat under the umbrella of good fat versus bad fat. Yes, they're very different, and health professionals know how to leverage good fat towards better health. However, for the most of us, if we're honest, we use the good fat versus bad fat logic to justify overindulgence. I know deep-fried Twinkies are not good for us, but if they're deep-fried in healthy avocado oil, they're not that bad, right? And don't tell me you don't do this because we're all guilty of it to a certain extent. I sure am. And in the same way, when we perpetuate and accept this myth of good debt versus bad debt, we can easily slide into borrowing more and more when we don't need to. My kid needs to borrow $50,000 for college. Well, it's for education, so it's good debt, right? Then shouldn't he borrow $70,000? More the merrier? The bank is offering a second mortgage at a discount interest rate. Well, I've been wanting to upgrade my kitchen, and besides, aren't home mortgages considered good debt? It's helping me to increase the value of my home. And little by little, we add just one more debt under the justification of good debt. Sounds like me when I just kept eating one more salted almond under the justification of good debt. Who cares if I finish the whole bag in one sitting? Bottom line, don't use logic like good debt versus bad debt to justify our financial decisions. Debt is like fire. It has a purpose, but if not managed right, it can quickly burn our house down. Number 8 dangerous money myth, keeping too many people broke. That used cars are not safe. Thus, you need to buy a brand new car, and you need to replace them every few years. Because, for safety reasons. Yes, if your wheel is about to fall off, and every time you take your car in for maintenance, the mechanic cringes, it might be time to upgrade. However, for most people, the car that you're driving is fine. According to Junk Car Medics, the average lifespan of a vehicle in the US is almost 17 years. And the average mileage of a vehicle, when junked, is approximately 156,000 miles. My guess is that many of you watching this video have cars that are nowhere near those numbers. But because of amazing marketing by the car makers, we can't help ourselves but constantly think about newer and supposedly better cars, without realizing that a new car can literally lose up to 20% of its value the moment you drive it off the parking lot, and after 5 years, it'll be worth no more than half its original value. Used cars, on the other hand, depreciate at a much slower rate than a newer vehicle. This is because once you're behind the wheel of a used car, it will have already undergone major depreciation. Bottom line, don't discount used cars under the myth that they're not safe. If you want some additional reassurance, consider a certified pre-owned vehicle. Vehicles that meet a manufacturer's established standards and carry some form of guarantee against defects similar to a new car warranty. The number 9 dangerous money myth, keeping too many people broke. I am too young to think about retirement. I have too many things going on in my life. I need to work on my career, my relationships, my hair. I need to enjoy it before I lose it. However, ask any older person what they think about this statement, and I guarantee you, almost every single one of them will say, you're never too young to think about retirement. They will all say, I wish I spent more time thinking about retirement when I was younger. I wish I had saved more. I wish I had invested more. If you're young and watching this video, don't think retirement is something that is too far away to think about. Ever heard of this riddle? What goes up but never comes down? Your age. Every one of us is getting older every single day. None of us are getting younger. So gift your future self by investing in your retirement funds. Invest into your 401k, into your Roth IRA, and any other tax advantage accounts available to you. Bottom line, you're never too young to think about retirement. Number 10 dangerous money myth, keeping too many people broke. Now the opposite of the earlier myth. I'm too old to catch up to retirement. I didn't save and invest when I should have. It is too late for me. I can never catch up at my age. It is all over. Well, let me tell you another fun riddle. What is always before you, but can't be seen? Your future. You lamenting over what you haven't done is pointless. Your past is the past and it belongs in the past. But your future? It is all up to you. That chapter of your life has not been written yet. You get to write that starting today. It doesn't matter how old you are. What matters is if you start now. Have debt? No problem. Let's start tackling that one by one. You haven't invested? Not a problem. Start with $1 and let's let compounding do its magic. Thank you guys for watching, and the line of it is never too late. Please check out my video on the top 5 regrets of dying here. Until next time, all the best.